Well, it's been a week, and it's time for another Lucia Capital Group weekly video. We talk a lot in the financial services industry about the importance of diversifying among asset classes, or in other words, not putting all your eggs into one basket. It's rarely a good idea to make a bet on a single sector or asset class or stock or single anything else, because that can really put much, if not all, of your portfolio at risk. So many planners often allocate a portfolio with a fairly simple mix of stocks, bonds, and cash. They look at this as a good blend of risk, less risk, and relative safety. But sometimes, for certain individuals, something more may be called for, maybe a little added diversification. This is where the idea of alternative investments comes in. So what is an alternative investment? I might define it as an investment with what we call non-correlating or negative correlating assets. When one asset in the portfolio is headed in a downward direction, we'd like to have a different asset that might be headed in an upward direction, or at least not another downward direction, given identical circumstances, the Zig and Zag approach. Technically speaking, asset correlation measures how and when investments move in relation to each other. When you have an asset that tends to move in the same direction at the same time, they are said to be highly correlated. When one asset moves up and the other moves down, those two assets are described as negatively correlated. Now, investments that don't necessarily move in any specific direction, just because another investment is moving in one way or another, are called non-correlating assets. A portfolio with a mix of all these types of assets can help reduce the overall volatility in the overall portfolio. Now, alternative investments, meaning basically anything other than traditional stock, bond, and cash investing, can include things like real estate, commodities, private debt, and so forth. So why might someone consider including alternative investments in their portfolio? One reason may be because by countering the price movements of a traditional investment portfolio, you can potentially reduce the risk in that overall portfolio. We've talked for years about the importance of minimizing downside risk, and it's often one of the chief characteristics of adding alternative investment strategies. Investment managers ideally seek to generate positive returns irrespective of the direction of the market, and this may be one way to do that. Of course, there's no guarantee this will happen, but the potential for more positive returns is somewhat greater with alternative investments in the portfolio, and reducing the risk may help achieve a more consistent overall return. Now, this doesn't mean everyone should have alternatives. Just by themselves, they may carry greater risk than some individuals can tolerate, and if that's the case for you, it's best to stay away. It's usually better to include them as part of an overall diversified portfolio, but even if alternative investments aren't suitable for you, smart diversification may still help you reduce your risk and increase your return when done properly. If you'd like to find out more about alternative investments and whether they're suitable for your situation, just give us a call here at Lucia Capital Group. We'll be happy to take a look, and as always, we're here to help.